Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on investing in a volatile market. As a result of the several events in the global space, ranging from the expected hike in interest rates, COVID variants, and the current debacle between Russia and Ukraine, the financial market has been experiencing a lot of volatility. On the domestic front, the upcoming election is also expected to pose a lot of uncertainties as the country elects a new president, with the incumbent unable to contest, having served his 2 terms based on the Nigerian constitution. Consequently, both experienced and less savvy investors will be keen to understand the best investment move to make in this period. This may apply mostly to investors that invest in high-risk assets such as stocks, both domestic and international, equity ETFs, equity mutual funds, as well as cryptocurrency. As you know, the return on this investment is not guaranteed like fixed income investments with capital preservation. Hence, it is mainly recommended for investors with a medium to high risk appetite and long-term horizon. Some of the recommendation tips to navigate the volatile market include: 1. Think long-term. There is always the urge to sell off your stock position to prevent further losses when the market is on a downtrend. However, you need to remember that the economy is cyclical. That is, there will always be ups and downs. The market has always rebounded after a significant downtrend or correction. As a result, it is the time to acquire stocks with solid fundamentals at low prices. In March 2020, during the peak of COVID-19 restrictions, there was significant volatility and correction in asset prices, but the market more than doubled from that level within a year. This is how great fortunes are made over time, as stated by Peter Lynch. 2. Avoid short-term trading. Short-term trading is when you buy and sell stocks with the hope of making profits from price fluctuations within a short period. This requires a lot of time and is highly risky as no one can accurately time the market. Emotions are highly involved because you take investment decisions to buy or sell based on your feelings, which could hurt your portfolio significantly. 3. Dollar cost averaging. Dollar cost averaging DCA is an investment strategy in which you invest funds at regular intervals over some time to reduce the impact of volatility on the overall purchase. DCA also helps to avoid the mistake of trying to time the markets. For instance, if you plan to invest 1 million naira in the stock market, you can split the funds into 10 equal parts and invest weekly or monthly. This will enable you to average your cost of the purchase over the period. 4. Purchase stocks with high dividend yield. During a period of volatility, fundamentally strong stocks sell at a cheaper price, allowing you to lock in the investment at a good dividend yield. The dividend yield is the return on your stock investment based on the dividend paid per share. For instance, if you purchase Zenith shares at 15 naira and the company pays a dividend of 3 naira for a year, the dividend return is 20%. This implies that if the company sustains the same dividend, you will continue to earn a 20% return annually, apart from the capital appreciation, that is, the return earned when a stock price increases above purchase price. 5. Diversifying your portfolio. Diversifying your portfolio is one of the best ways to keep yourself composed and your overall investment steady during a volatile market. This implies that your investments are spread across different sectors and asset classes. One of the sectors may be down now while the other is up, limiting your investment losses. 6. Sector rotation. Sector rotation is the movement of money in the stock market from one industry to another as investors anticipate the next stage of the economic cycle. For instance, investors can increase investment in financial services in the US due to the expected hike in the interest rate and reduce exposure to COVID-19 stocks, which have enjoyed major market rallies in the last 18 months. Overall, if you are approaching retirement, your focus should be on protecting your investments. Hence, you should only invest in assets with capital preservation. Thank you for listening. Please join us same time next week for another interesting and insightful session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 070 8246 3747. Stay blessed.